Welcome to Macro Hive Conversations with Bilal Hafiz. We aim to bring you the best in macro and markets thinking. To see our latest thoughts and analysis on the world, visit macrohive.com. This week, we had the first Fed meeting after the Jackson Hole Symposium, where the Fed introduced average inflation targeting. Many investors thought that the Fed would give much more detail on how they were going to target inflation. Yet the main outcome of the Fed meeting was that the Fed stated that it would not hike rates for many years to come. And as usual, as is becoming a pattern around Fed events, equity markets sold off on the day. We feature many pieces on this topic on the Macro Hive site, along with pieces on Trump's poor polling, Bank of England's next actions, how big tech will disrupt monetary policy, and much more. To access these articles, all of our archive and our lively Slack channel, become a member on macrohive.com. It's only the cost of a few weekly cappuccinos, and the first month is free. We also have a more high-octane product which includes trade ideas. One investor and a few customers this week asked me how successful our trade ideas have been this year, so I totted up the performance of the trade ideas, and the ideas have delivered an annualized return of around 14% with a Sharpe ratio of 1.9. So if you're interested in this product, drop me an email at bilal@macrohive.com and I can tell you more. Now, onto this episode's guest, Michael Pettis. Michael is someone who I've long followed over my career, but this is actually my first time to directly speak to him. He is one of the most widely followed China experts in the investor community, and I would say he is one of the people you have to follow if you are interested in global macro. He's currently based in Beijing and is Professor of Finance at Guanghua School of Management at Peking University. He's also the co-author of the recently published book, Trade Wars Are Class Wars: How Rising Inequality Distorts the Global Economy and Threatens International Peace. On to our conversation. So welcome, Michael, to our podcast show. It's a great honor to have you on. I followed your work for many, many years now, and I've been a big fan of yours. So this is actually my first time to directly speak to you. So it's a great pleasure for me to do that.
Thanks very much.
Well, I thought, first of all, Michael, before we kind of jump into your sort of macro thinking and your recently published book, it'll be useful to get a sense of your background. I don't actually know as much about your background as I perhaps should have. So where did you grow up? Why did you want to study economics? What was your finance career like? So maybe if we kind of start from the beginning, that might be sort of interesting for our listeners to know.
Well, I grew up in a lot of different places. My dad's American, my mom is French. I was born in Spain. And I grew up primarily in Spain, Pakistan, and Peru, although I went to boarding school in Morocco. And because of my mom, we spent a lot of time in France. So my background is very mixed that way.
Was your father in the army or something? Why such eclectic countries?
My father was a geologist and a civil engineer. He was a pretty well-known civil engineer. And he worked on roads and dams and bridges, things like that. And he particularly liked working in developing countries. And at the time, southern Spain was sort of a developing country. That became our headquarters. That's where we lived. And then we traveled around the world and always returned there. After graduating from high school, I went to Columbia University. And I pretty much spent most of the next several years in New York City. After I graduated, I got 2 graduate degrees from there, including at the business school. I ended up totally by accident. I really wasn't planning it, but I ended up on Wall Street and I ended up trading the restructured debt of the so-called LDCs in the Ldc Debt Crisis, which mostly meant Latin America. I forgot to mention one of the countries that I grew up in was in Peru. So I had a strong Latin American background, and because of Spain, obviously I spoke Spanish, and I was very eager to get into Latin America. But at the time, when I graduated, it was during the Ldc Debt Crisis, and it was really hard to get a job in Latin America, and I managed to finagle my way in. And I was very lucky because it was just before it took off. So I ran fixed income trading and capital markets desks at various firms, JP Morgan, First Boston, and Bear Stearns, which is now JP Morgan. And, that was all a lot of fun. But by the end of the 1990s, I was getting a little bit bored. And I decided that I wanted to go to either India or China for a couple of years and learn something that I knew nothing about. And so in 2002, I moved to China. The plan was to move there for 2 years and then return to Wall Street, return to New York. But my planning was never very good. I ended up spending, 18 years and counting. And during this time, I've been teaching at Peking University and doing a bunch of consulting work. I should mention that before coming to China, while I was working on Wall Street, I taught at Columbia as an adjunct. So I have both a Wall Street background and a reasonably academic background. You mentioned what convinced me to study economics. Well, actually, I didn't. As an undergrad, I studied physics and philosophy. And in grad school, I studied development economics, which at the time was not considered real economics. At business school, I studied finance. I sort of ended up accidentally in economics.
Okay, yeah. I mean, did your kind of eclectic upbringing, your time in trading and LATAM, I mean, did that help inform your views of China over the years or not?
Oh, definitely. One of the problems with academic economics, I mean, there are a lot of problems with it, and I think it's very severely criticized, and rightly so. But one of the big problems is that economists don't really understand debt. They don't really understand, how do you measure too much debt? What are the consequences of debt? Why do you have debt buildups, et cetera, et cetera? And I think, coming from a very strong debt background, that helped me a lot. The other thing is when I came to China, and it's still a problem to a certain extent today, there is this perception that China is sui generis, right? That nothing like this has ever happened before in history. And of course, whenever someone tells you that, it's nonsense. And so when I came to China, I was one of the few people who really came with a developing country background. And China, we often forget this, is just a very big developing country with many of the strengths and weaknesses of developing countries. And it's followed a growth model that many other countries have followed before. It's just done so more intensely than other countries. So that I think gave me a certain advantage in being able to place Chinese growth within context.
Yep, understood. And that actually brings us nicely to your recently published book that you've co-authored with Matthew Klein. The full name gives it away. Trade Wars Are Class Wars, How Rising Inequality Distorts the Global Economy and Threatens International Peace. I finished the book a few days ago, and I was quite impressed about, first of all, the range of countries you talk about in there, tying back to what you just said about how China is not some unique phenomena, but also the historic cases you use, going back to the 18th century, going back to Adam Smith and so on. So you seem to like to, use history to inform your views as well as the cross-section of countries in the more modern period.
Well, yeah, I think one of the things that was very important for both Matt Klein and for me is that we tend to have a very systemic view. We think in terms of systems, both the country as a system and the country within the global economy, which is a system. And I think you get a much better sense of that from the history. And I think, frankly, it's another one of the big weaknesses of academic economics, which tends to be very linear. It tends to assume that systemic constraints don't exist. So one of the things that we really try to do in the book is to place the major economies, especially the US, Germany, and China, within the systemic constraints, and to make it very clear that, if you're Singapore, you can treat the rest of the world as infinite. But if you're Germany, Europe, the United States, any large economy, China, you can no longer do so. And what ends up happening is that anything that one country does through the balance of payments mechanism automatically must have an equal and opposite reaction in the rest of the world. So if you increase your savings rate relative to your investment rate, whoever you are, the rest of the world must increase their investment rate relative to their savings rate. Something as simple as that, I think, is very often forgotten. And we wanted to make that at the heart of our approach towards understanding trade and the balance of payments and balances.
Yeah, absolutely. And you do talk a lot about the relationship between investments and savings. And so if we kind of dive a bit more into that, one thing is there's generally this notion that high savings is good because you're frugal, or it can eventually lead to more investment. How do you look at high savings, low savings, or how do we kind of define high and low savings?
Well, one of the things that I try to teach my students is that, unfortunately, many of the claims made in economics are more ideological than pragmatic. So when people say high savings are good or high savings are bad, or trade deficits are good or trade deficits are bad, or supply side economics makes sense or supply side economics is voodoo economics, they're all wrong. I mean, that's the wrong way to approach it. The correct way to approach it, I would argue, is to figure out what are the conditions under which high savings are a good thing and what are the conditions under which it's a bad thing. And what we argue is that for much of history and today for certain developing countries, for most developing countries, there is a savings constraint. In other words, investment needs, desired investment, is greater than actual investment. And what prevents the gap from closing is the lack of savings. In that case, it's absolutely true that you want to increase the savings rate, because when you increase the savings rate, you increase investment and therefore you increase future growth. But we argue that basically since the 1970s, the world has operated in a very, very different set of circumstances from classical economics, and that is that we no longer really have the savings constraint for most advanced economies, or for any of the advanced economies. In countries like the United States, Europe, England, Australia, any of the advanced economies, and even in some developing economies in East Asia, there is more than enough savings to fund all desired investment. That doesn't mean that there aren't good investment opportunities. For example, we all know the US should really be investing in infrastructure. But the reason it doesn't do so is not because the cost of capital is too high or because of a savings constraint, but for political reasons. If you want to invest in the US or England or anywhere else, you can obtain as much capital as you want at the cheapest rates in history. In fact, before COVID-19, American companies were sitting on huge pools of cash. The only thing they were doing with it is buying back their own stocks. They were not investing it. So clearly there was no savings constraint on investment. In that case, we would argue that increasing the savings rate, which is another way of saying reducing the consumption rate, actually reduces growth. Because if you reduce consumption, then you reduce the incentive to invest, because there isn't this high level of desired investment that exceeds actual investment. In this case, desired investment depends on the demand for whatever it is that you're producing. So ultimately, that's consumption. So what we argue is that if you are a savings-constrained economy, which was true for most of the world until recently, and is true for certain developing countries, then policies that raise the savings rate reduce current consumption, but they increase future growth, so they will increase future consumption. But if you are not in a savings-constrained economy, then increasing the savings rate is impossible, because savings can only go up when investment goes up. And the way you increase ex-ante savings is by reducing consumption, typically by moving income away from the high consuming part of the economy, which is basically ordinary households, to a low consuming part of the economy, which is the wealthy or businesses or the government. And when you do that, although your ex-ante savings rises, in other words, the savings of the rich will go up, if investment doesn't go up, then savings cannot go up. And investment doesn't go up, it actually tends to go down, as we saw in the case of Germany, in which case higher savings among the rich must be matched somehow with lower savings in another part of the economy. And what we show in the book is that the way that lower savings, that balancing reaction occurs, is one of three ways. Either unemployment goes up, which of course reduces the savings rate, or household debt goes up, which of course reduces the savings rate, or the fiscal deficit goes up, again, which reduces the savings rate. And so what we argue is that as processes take place that tend to force up the savings rate, in this case, as you have rising income inequality, the result is not more savings and more investment. The result is a choice between more unemployment, more household debt, or more fiscal deficits. And as we've seen in the last 30 or 40 years, that's exactly what's happened. You get rises in household debt and fiscal debt, and then from time to time, those rises are interrupted, in which case you get soaring unemployment. So that's our point. Savings can be a good thing, they can be a bad thing. It depends on the circumstances.
One or two things I take away from that is, one is something happened in the 70s onwards, which removed the sort of savings constraint. It globalized the savings pool, which presumably must be financial capital account liberalization. So capital was able to move around the world much more easily.
Bilal, I would say it was something different because what we actually saw was the first people to really understand this were John Hobson in England and Charles Arthur Conant in the United States. And they were writing about this at the end of the 19th century.
Okay.
When countries like England had an excess savings problem. The reason I would argue that their explanations sort of disappeared was because shortly afterwards, John Hobson's book was published, I think, in 1903. And 11 years later, World War I started, which created massive destruction of wealth, and then followed 20 years later by World War II. So basically, the first half of the 20th century was characterized by these two very destructive world wars, which had two impacts. One, by destroying infrastructure and manufacturing capacity, they caused a huge increase in investment needs. But at the same time, by destroying wealth, they caused a collapse in savings. So we reverted to a world in which investment was constrained by scarce savings everywhere except in the United States. And it's not a surprise that the US was the world's biggest exporter of savings during that time. But by the 1960s or 1970s, Japan and Europe was largely rebuilt, in which case their investment needs came down and their savings capacity went up. And so we reached the point where the world was really characterized by excess savings once the global economy was rebuilt from the two world wars.
So in that case, I guess what you're saying there is that the investment needs kind of got met almost, that there was less investment needs, which then resulted in kind of excess savings then.
Exactly. When you destroy Germany or Japan or Belgium or whatever, you have to rebuild. So you've got these huge investment needs. But once they're rebuilt, of course, you no longer have such urgent requirement for investment.
And so if we use China then to look at this way of looking at things, China obviously was developing economy after the war. We had the reforms, which saw some rapid growth in China. So, at what point, how would you view the evolution of China through this lens of investment needs being met or excess savings and so on?
Well, China is a very good example. In fact, I would argue that one of the big advantages of being in China and looking at China is that you see all of these problems in the global economy, but they're exaggerated within China. So they're much easier to see. In the case of China, when the reforms began in the late 70s, early 80s, China was characterized by two things from this point of view. One was it was extremely poor. And like most very poor countries, it had very low savings. The other problem it had was that after 5 decades of anti-Japanese war, followed by civil war, followed by Maoism, China was hugely underinvested. It had, I think, 4 commercial airports in the whole country. It didn't have a single subway line. It had very few highways. It had a decrepit rail system, et cetera, et cetera. It had no manufacturing capacity or very poorly constructed manufacturing capacity. So it was characterized by very low savings and very high investment needs. So the model China implemented, which they didn't invent, dozens of countries have followed this model, I call it the Gerschenkron model, is that they forced up the savings rate. And the way you force up the savings rate is very straightforward. Take money away from consumers, that is ordinary people, and give it to savers, that is the rich, businesses, or the government. And so China put into place a model in which the growth in household income heavily subsidized the growth in GDP. But because China had such huge investment needs, as the savings rate went up and it was poured into investment, China grew very, very quickly. So you would see China growing at 10% or 11% for 20, 30 years, but household income only grew by around 7%. Now, I say only, that's a great number, but you have to understand that it means that the household share of GDP is contracting steadily year after year after year. And as it contracts, the consumption share contracts and the savings share rises. So this was exactly the right model for China. And it was very successful for 20 or 30 years. The problem is when you have the highest investment rate in history of any country, and also the highest growth rate in investment of any country, these are two separate things, but China was number one in both of them, then you start to close that gap between actual investment and desired investment fairly quickly. And I would argue that China closed the gap basically in the end of the 90s or the beginning of the last decade. When that happens, savings no longer becomes the solution to your problems. Savings becomes the problem itself. And China recognized this at least by 2007, perhaps even earlier, when they promised to begin rebalancing the economy away from savings, away from investment towards consumption. The problem is a political problem, and that is if you want consumption, if you want to bring investment down, then you run the risk of a huge increase in unemployment. If you don't want the unemployment, then you have to have either a huge increase in your trade surplus, and China was too big to rely on that, or a huge increase in consumption. So you have to bring up consumption, but there are only two ways you can bring up consumption. One is to raise household debt, which China did in the last 5 years. Household debt soared, but that's not sustainable. And the other way is to increase the household share of GDP. The problem with increasing the household share of GDP is that if I increase my share, I must reduce your share. And in the Chinese context, you are the local provincial elites and governments, and you're very powerful. So that's been the problem China's faced. It's very difficult to manage this redistribution of wealth.
This is where the class dynamics and the income inequality dynamics come into the equation then. So even though the technocrats, if we can call them that, would know that you should reduce savings and have this rebalancing, there's political constraints as the elites don't want this to happen. And so if you carry on with that high savings model, what's the result for China? Presumably that means higher debt, and it also has global implications as well, presumably.
Yes, unfortunately, it was made worse by COVID-19, but China is remarkable in that it has the highest investment rate in history, and yet it still runs large current account surpluses, which by definition means its savings rate is even higher than its investment rate. So when your savings rate is so high, there's only two things, and you don't want to invest. You don't want to increase investment because so much of it is non-productive. China has long ago reached the point where additional investment is non-productive. Then if you are unable to bring up your consumption rate, then you face a choice between unemployment or higher trade surpluses. And China has chosen higher trade surpluses. This is the point of the trade wars or class wars, because what we argue in our book is that trade war isn't, or trade conflict isn't a conflict between nations. It's a conflict between economic sectors. So why does Germany have a surplus? It has a surplus because of labor reforms which forced down wages and forced up business profits. But if you do that and the savings rate rises and you are unable to invest it domestically, then you must export it abroad. In this case, let's say to Spain. Now, Spain is receiving all of this German investment, all of these excess German savings are flowing into Spain. So the Spanish economy has to adjust, either by raising the investment rate or by lowering the savings rate. And it couldn't really raise the investment rate because Spain was a developed economy without a savings constraint. Investment did go up a bit, but much of it was non-productive. But in the end, if investment doesn't go up, savings must go down. And how do savings go down? We saw very clearly household debt in Spain exploded. The government actually ran a surplus. They were quite prudent, but household debt had to explode because the alternative to an increase in household debt had to be an increase in unemployment. And in 2009, we saw that very clearly. Once debt in Spain could no longer rise, unemployment soared. So what we argue is that to say that this is a conflict between Spain and Germany is nonsense. Basically, German workers got screwed. to the benefit of the owners of movable capital and the financial system in Germany. And that translated into a system in Spain in which, again, the bankers and the owners of movable capital did very well out of all of this. It was the Spanish workers and the Spanish middle class that paid for the cost of the adjustment. So we would argue that in both countries, the same groups of people benefited at the expense of the same groups of people in either country.
And presumably the elites, say in Germany and in China, have an incentive to frame the problem as a trade war rather than a class war, presumably, to kind of focus then on the profligate Spanish or, the lazy Southern Europeans, and frame it kind of in that way rather than to focus internally on the internal class dynamics of the countries.
Yeah, I don't know if that was intentional or if that's just the way we think, but certainly when you run a trade deficit, the assumption is you must be lazy and inefficient. And when you run a trade surplus, the assumption is you must be hardworking and very efficient. But there's two problems with that. The first is that that's not what the data tell us. Spanish workers worked more hours every year than German workers, far more. And more importantly, the reward you get, if there is such a thing as a hardworking country, and every country I've ever lived in has been hardworking, imagine there is such a thing as a hardworking country, the reward you get is not a trade surplus. The reward you get is that for every unit of exports, you can get more and more imports, improving terms of trade. You don't run surpluses, you run improving terms of trade. But you look at countries like Germany, Japan, China, they run surpluses. So what does that reflect? That reflects distortions in the distribution of income. In all of those countries, workers earn less relative to their level of productivity than do workers in other countries. That's why you run surpluses.
And how about the US within this framework? Presumably China is the main exporter of savings rather than, say, Germany, I suppose, to the US.
No, Europe too. Europe is a net exporter of savings. China is an exporter of savings. Japan is a net exporter of savings. Now, in the US, you would think the US, the UK, and the so-called Anglo-Saxon economies are a little bit different. You would think that because all of them are highly unequal economies where we have significant income inequality, they should all have very high savings rates and they should all be exporting their savings and running their trade surpluses, just like China and Germany and Japan. But none of them run trade surpluses. They all run trade deficits. And we argue the reason is because all of these excess savings have to go somewhere. They should go to developing countries, but we don't like lending money to developing countries because of credit concerns. So most of the excess savings, roughly half of it goes to the US, and roughly half of whatever is left goes to the UK, Australia, Canada. And why is that? Well, we argue because they all share something which are very open, deep, and flexible financial markets with really high quality governance. So basically, you invest in the US or the UK not because they need the money, but because they are the only safe places in which you can invest large amounts of money. The rest of the world, you can't. And as a result, because those countries are capital importers, not because they need the capital, but because they have open capital markets and so have no choice, then in those countries, you run the problem that investment must exceed savings. And since investment doesn't go up, savings must go down. So that means in all three countries, they have to choose, or all four countries, they have to choose between more unemployment, more household debt, or more fiscal deficits. And typically they choose more household debt or more fiscal deficits. But every once in a while, they are forced to choose more unemployment.
Earlier, you mentioned, take the US. I mean, there are still huge infrastructure needs in the US to upgrade, the infrastructure there. Probably you could say the same about the UK as well. So why doesn't all of this excess savings go into things like that? Just improve the infrastructure, improve the airports, improve broadband access across the country, improve access to education and so on.
It's a bit of a mystery because contrary to a lot of conventional thinking, Historically, the US government, both at the federal level and at the state level, played a major role in building American infrastructure, right? This dates back all the way to the Erie Canal, which was maybe the most successful infrastructure project in history back in, I think it was 1819. The US has always done that. But it seems we went through this ideological change in the 70s and 80s in which we lost that pragmatic approach and we developed what people dismiss as neoliberalism or laissez-faire capitalism or whatever you want to call it, in which we convinced ourselves that there is absolutely no role for the public sector in infrastructure spending. So we allowed our infrastructure to rot away. And this has created a huge problem for the US economy. But I would argue that the US and Europe too, but let's focus on the US, has terrible infrastructure. It's almost third world in many places. And it has an unemployment problem. It has a problem of weak demand. And it has massive amounts of savings being offered to it at the lowest interest rates in history. So clearly it should take advantage and rebuild American infrastructure. And I think it will. I think eventually we're going to figure it out. But it just seems to me that sort of the ideological opposition to the idea of government intervention in the economy, which is really bizarre because it's quite new, is still strong enough that there is this great reluctance to do it. But we will do it. I mean, the US has always been ultimately fairly pragmatic.
It seems like the channel through which everything is resolving itself at the moment is just higher debt everywhere. You say sort of in China it's higher debt, in the US, it's higher debt. Interest rates are low though. So there's a big debate then that as interest rates are low, then this is sustainable, this kind of system. I mean, within your framework, how do you think about debt, the level of debt, or is debt too high?
Well, it's like Japan. Japan has an incredible debt burden. And everyone says it's not a problem. Interest rates are zero, so they don't have to pay anything. Yeah, interest rates are zero, but growth is zero too. And it has been. It's hard to remember that only 30 years ago, anyone who didn't think that Japan was the most dynamic, rich economy in the world and would, within 1 or 2 decades, become the world's largest economy, could only be a racist because there was no other way, not to recognize what was happening. And it turns out that was totally wrong. We saw, a collapse in Japanese growth. Japan used to be 17% of the world. Today it's around 8% of the world. And I would argue that's not a coincidence. I would argue, and other people are making the same argument, that the debt itself prevents growth, which keeps interest rates low. So we're locked into this mechanism where we can't grow, because if we were to grow, we would have higher interest rates, which would make the debt burden unbearable, which would then bring growth rates down.
Yeah, understood. I mean, it then kind of begs the question of, say, with China, I suppose in the case of China, growth rates have fallen. They were like 10% plus 14%, before the financial crisis, and now they're going down to 5, 6, 7%. Notwithstanding COVID. For a country like China, many people try to forecast hard landings and crashes and those sorts of things. What do you think the path of a country like China is? Will it follow somewhere like Japan, where you end up just with very low anemic growth for a long period of time, growing debt levels, and it's sort of losing its overall share of global GDP? So it follows effectively the path of Japan from the 80s to the 90s, the lost decades.
Well, every country that's followed this growth model has had a pretty similar path. First, you have, by this growth model, an investment-driven savings growth model. First, you have very rapid, healthy growth, followed by a period of rapid but much more feverish growth driven by an explosion in the debt burden, followed by an adjustment. And the adjustment can take place in 2 different ways historically. One way is in the form of a debt crisis. So the US in the early 30s, Brazil in the early 1980s. The other way is in the form of decades of stagnation. So the Soviet Union in the 70s and 80s, or Japan in the past couple of decades. And it's one or the other. I would argue that a debt crisis politically and socially is much worse, but the decades of stagnation economically are much worse. So it's sort of a choice. Now, which one is China likely to follow? Well, I would argue it's very unlikely to have a debt crisis. I've always argued this because a debt crisis is a balance sheet problem. you have a significant asset liability mismatch, and then you have some event that prevents or limits your ability to turn over your liabilities, and then both sides of the balance sheet contract. But as long as the Chinese banking system is closed and the regulators are powerful, they can, and in every case they have, restructure the liabilities at will, so you never have a liability asset mismatch. On paper, it looks terrible, but in reality, it isn't. So as long as those conditions remain, and that's an important point, because with more and more foreign investment in China, this becomes harder and harder to maintain, but it's still low relatively. As long as those conditions remain, I think it's very unlikely China will have a debt crisis. But what will happen is that once debt can no longer grow at 1.5, 2 times reported GDP, then GDP growth will collapse. It'll drop to very, very low. Now, there's an important point here, because last year China grew at 6.1% officially, but it really didn't. And this is one of the points that I try to make. So yesterday, for example, the OECD revised upward their estimates of Chinese growth for 2020. As late as June, they were saying that the Chinese economy would contract by 3.7%. Yesterday, they said it would expand by 1.8% or something like that. Now, that's a huge difference. And that should be incredibly embarrassing. But what I would argue is that that tells us a really important story. And it's not just the OECD. The IMF has made the same upward revision from negative growth to positive growth. Most of the investment banks have done it. And I would argue the reason is because GDP growth in China does not mean what it means in other countries. In other countries, GDP growth is a measured output. The economy does what it does, and then you measure the results, and either the economy is up or the economy is down. And clearly, COVID-19 was going to cause a contraction in the economy. But in China, GDP growth is not an output, it's an input. The government tells you what it's going to be. In December of the year before, we know what GDP growth is going to be. Not this year, because COVID-19 changed everything. But we generally know what the GDP growth is going to be. And why can't every country do that? Well, because of a really, really important accounting condition. In most countries, if you spend $100 to build something worth, in the end, only $20, the expenditure raises the GDP, and then the writing down, the acknowledging of that loss, the recognition of that loss, reduces the value added component of GDP. So it doesn't enter into GDP. It enters temporarily and then is removed. But in China, you don't write down bad investments. You just continue rolling them over. So if you can imagine that there are two Chinas that are identical, everybody doing the same thing, the only difference is that in the first China, you write down bad investments in line with other countries, maybe not perfectly. And in the other China, you don't. Those two Chinas are going to report completely different GDP numbers. And it's the first China that is comparable to the US or Brazil or Germany or England or whatever, not the second China. But we don't know what the first China's number is. We just know the second China. And what I would argue is that all of those quote unquote bad growth predictions were bad only because they were implicitly trying to explain what would happen in the first China. But in the end, what we get is the data from the second China. The real economy contracted. You can tell because consumption is down, exports have barely broken even and private investment is down. Those are the healthy parts of the economy. The only reason GDP is higher is because real estate and public sector investment are up. And both real estate and public sector investment create non-economic value. They build empty apartment buildings, or they build bridges that we don't need, or they extend subway lines further than we can use them, or build additional airports, et cetera, et cetera. So what I would argue is that GDP growth in China, real GDP growth, is much, much lower, but we're able to show a higher rate because of the failure to write down all of this non-productive stuff. And ultimately, all of this, what Galbraith referred to as the bezel, the gap between real economic value and the reported economic value created by the liquidity bubble, ultimately that gets written down. And once debt stops growing, we're going to see all of that reverse.
Yeah, I'm understood. Yeah, I mean, I've looked at sort of the Chinese data over time, and you're right. I mean, the real GDP numbers aren't really that useful at all to understand the cycle there. I find nominal GDP is a bit more useful. So it seems like there's some kind of adjustments to the deflators that allow them to smooth out real GDP. And certainly there's other indicators.
Yeah, we know that's happening because if you look at nominal GDP numbers, they bounce all over the place. And then you look at the GDP deflator, it bounces all over the place. And then you combine the two, and by some miracle, you get really smooth real GDP growth.
Yeah, I'd agree. How does something like the dollar fit into this whole equation? You know, you talk about this in the book as well. There's a kind of conventional view that the US benefits from being the dominant currency of the world, the exorbitant privilege and the seigniorage benefits and so on. How does the dollar fit into the equation?
I see the dollar as sort of like exaggerated version of military defense spending in the sense that the dollar gives the US tremendous geopolitical power, just like all of our defense spending does, because basically we control the global financial system, and through that we have enormous ability to sanction countries that don't do what we want. But it's a mistake to think that this is a privilege. This comes at an enormous cost, and the cost is to the US economy. Because the dollar is the dominant reserve currency, because it's the currency in which you stuff all of your excess savings, remember that that means that the US, because we don't use it to boost investment, that means that it must come at the expense of rising debt or rising unemployment. So it undermines the US economy in the long run, but it benefits the US geopolitically in the short run. So I would argue that that is something that we should not only be willing to give up, but that we should be eagerly trying to give up. We should go back to the old Keynesian proposal for Bretton Woods, in which, and by the way, Harry Dexter White agreed with this, in which we impose capital controls and we insist that both sides of the imbalance, the surplus side and the deficit side, must make the necessary adjustments to bring trade back into rough balance.
So say on the Chinese side, then presumably if China wants to rebalance towards the consumer, that should imply a much stronger renminbi over time to force that rebalancing. Whereas if they try to promote the export model or the overinvestment model, then they'll try to promote a weak currency. I mean, do you think there is a change of mentality around the renminbi by policymakers in China?
In fact, I would generalize. If you want to promote domestic consumption, you have to raise the household income share of GDP. Strengthening the currency does that by basically transferring income from net exporters, who are the manufacturing sector, to net importers, who are households. You can also do it by raising wages. You can do it by raising the deposit rate on household deposits. You can do it by strengthening the social safety net. You can eliminate the hukou requirements. You can improve the quality of water, reduce urban fees, et cetera. So there's a lot of ways of doing it. If you want to strengthen the export sector, though, you have to do the opposite. You have to reduce the household share of GDP in order to subsidize exports. So this is one of the problems China faces, because it wants to strengthen the export sector while using that strength to shift the economy towards domestic consumption. And I would argue that, that's great, but that's like eating your cake and having it too. You do one or you do the other. You can't do both. If you want to strengthen the export sector, then you're going to see continued weakness in domestic consumption, because you're forcing households to subsidize the export sector. If you want to strengthen the consumption sector, then you have to reduce those subsidies, and that will significantly weaken the export sector. So we'll see what China is doing. It's trying to do both, but it can't. So we'll see which way ultimately it goes.
I mean, do you have a view on the direction of the renminbi or the dollar in general?
Well, I've argued for years and years that this idea that the renminbi is going to collapse is simply not true. As long as the PBOC has enough reserves to defend the renminbi, and they have a lot of reserves, officially 3 trillion, but probably a lot more, then they can defend the renminbi as long as they want. And why would they defend the renminbi? People say that if your economy is slowing, you should depreciate your currency and you'll grow more quickly. That's nonsense. That's true if you're a deficit country. Because remember, if you're a deficit country, investment is greater than savings. So you rely on foreign capital inflows. And as you slow, foreigners become less eager to invest. And so your investment drops. But China is a surplus country. It has too much savings. Depreciating the currency will increase the savings rate, which is the last thing they want. They want to reduce the savings rate. So the renminbi is going to be, fairly stable, not necessarily against the dollar, but against the basket of currencies. When the dollar weakens, the renminbi strengthens against the dollar, but not against the basket. And that's what's been happening in the last year or so, or last 2 years. Most of the strength and weakness in the renminbi has really been weakness or strength in the dollar, not so much strength and weakness in the renminbi. It's been fairly stable. Now, what's interesting is that it does seem to be going up a bit. And the question is why? When you add up all of the visible components of the balance of payments, you would assume a really big increase in reserves in say, the last 4 or 5 months, and in the last 2 years. But you're not seeing that. Reserves have been pretty flat basically since the end of 2016. And so we're all wondering what's going on, and I don't have evidence yet. It's really hard to get through the numbers, but I suspect that there are reserves being diverted into other areas, but that they should be thought about as reserves.
Yep, understood. There's so much more we could talk about, but I know we can't double the length of the podcast. But is there any kind of major theme from the book that you think we haven't touched on?
Well, we've touched on it, but I would want to stress again how important this issue of income inequality is and how the global trading regime reinforces it. Because global trade is a good thing if it forces countries to compete by improving productivity. But with such low transportation costs and with the enormous ease of moving capital around the world, the way we really compete, the way you gain international competitiveness is by lowering wages, either directly like Germany did, or indirectly by depreciating or undermining the social safety network or allowing environmental degradation, et cetera, et cetera. And it's really amazing once you think of it this way, how much clarity there is in basically the global economy over the last 3 or 4 decades. We've seen this process in which countries increasingly compete by lowering wages. So the share of, say, the bottom 50% of the population of total wealth has declined very rapidly. Household debt has exploded. We've seen an undermining of the social safety net in Europe and in the US. All of these things which naturally follow from this system. And the reason income inequality is so bad for us is because the constraint in investment right now is not savings, it's consumption. And income inequality weakens consumption. And so therefore it also weakens investment. The complete contrary of what the supply siders say. They say more savings equals more investment. No, not necessarily. It depends on the underlying conditions. And we're stuck in this process in which we have weak demand, which leads to more income inequality, which leads to more weak demand. So we're going to break out of it one way or another.
No, that's a very good point. Once you understand the system in this way, then it allows you to think more clearly what the potential solutions are. So rather than having a trade war, tariffs, and instead the point is to think about how do you raise consumption amongst, say, the bottom half, the distribution of the population, which may well be sort of raised wages, social safety nets, all of those sorts of things.
Including investing in productive infrastructure, which China can no longer do, but certainly the US and Europe can do.
Yeah. Now, I always like to ask my guests some personal questions as well. One, I'm a researcher and I consume lots of different research notes and other types of content. And it gets overwhelming when one thinks about all the potential sources of information and knowledge that's out there. How do you go about managing your content inflow and information and so on?
It's hard, and particularly in this COVID-19 world, it seems to have become actually harder. But I save a lot of time for reading books on economic and financial history, which I think are really, really important. But, one big advantage I have over many other people is that as a professor, I can call on a group of really brilliant students that I have in this special seminar. And they help me a lot when I'm looking for data on the Chinese economy. So that's very helpful. But generally, like everybody else, I read newspapers and research reports and data and try not to get drowned by the whole thing.
And on your sort of personal productivity, you're very prolific, I've noticed. Recently, you've come out with a book. You're often writing comment and articles on the Chinese economy. You obviously have your academic role as well. How do you fit everything in? I mean, do you have certain routines that you follow, or how do you sort of squeeze so much into a day?
Well, thanks for saying that. I think I'm lucky in that I can mostly do stuff that I find interesting. So it doesn't really feel like work. And this is a bit of a secret, but academics won't like me to say this. But when you've spent a few years on Wall Street, being a professor is really not very time demanding. So you end up with good work habits and a lot of free time.
Okay, yep, understood. And then finally, I'm a big lover and reader of books. What books have historically sort of influenced you the most in terms of your work context or at personal level?
Everything by Charles Kindleberger. I've read everything and I recommend it all. I've read all of Adam Tooze's books and I think they're all really great, but I think his Deluge, his book on the impact of World War I on the global economy and global political system, is one of the best books I've ever read. Barry Eichengreen's Golden Fetters is, I think, just required reading if you want to understand what happened in the 1920s and 1930s. And I just finished, I wish I could remember the name of the author, but this new biography of, relatively new, it came out 2 or 3 years ago, of Mariner Eccles, who was the president of the Fed under FDR, and one of the most brilliant unknown economists of the 20th century. And I strongly recommend reading everything you can about him.
Okay, no, great. That's some books to add to my list. That sounds really good. And for people that want to follow your thinking or your work, what's the best way people can follow you?
I've been doing a lot on Twitter, and I have a blog on the Carnegie. I'm part of the Carnegie Endowment, and on their website, I have a blog in which I do quite a lot of writing.
Okay, that's great. So with that, I'd just like to thank you very much for super informative discussion. I'd also recommend all our listeners to get hold of your book as well, Trade Wars, Class Wars. Again, I'll add the Amazon link to that, to the show notes as well.
Great. Well, thank you very much, Bilal. This was great.
Thanks for listening to this episode. Please subscribe to the podcast show on Apple, Spotify, or wherever you listen to podcasts. Leave a rating and let other people know about the show. Also, sign up to become a subscriber to our research at macrohive.com. We'll be back soon, so tune in then.